Global markets closed last year with much optimism around the reopening of the global economy. Data was indicating that a lot of the supply chain bottlenecks that we were seeing were starting to ease. For example, when looking at port congestion in Shanghai and in Los Angeles, as well as the cost of shipping containers. At the same time, many policymakers were still talking about higher inflation rates as a temporary phenomenon. Now, fast forward to the second quarter of this year, and the outlook has significantly deteriorated. US inflation, in particular, continues to be at very high levels, and the US Federal Reserve, in response, continues to hike rates until inflation begins to cool off. In China, the situation is very different in terms of monetary policy. It is still on an easing path as the economic outlook has deteriorated, particularly after some strict COVID-19 lockdowns that were introduced again this year. Now, beyond China, in emerging economies around the world, we've seen food and energy prices spike. We've seen higher inflation rates and central banks reacting to that by raising rates in order to tame inflation, but also to stem capital outflows. In the euro area, stagflationary risks are building up. The European Central Bank is behind the curve in this tightening cycle and has not raised rates yet, despite persistently higher inflation that has been very much driven by higher energy prices, particularly as a result of the war in Ukraine and the sanctions against Russia. So there is a cost of living crisis emerging in Europe at the moment as a result of that. In Japan, the situation is very different. The central bank there is a notable holdout in this tightening cycle, sticking very much to its ultra-loose monetary policy despite a deepening in the sell-off of the yen recently. So the big question that is top of mind for many investors at the moment is, will the global economy stagflate, or will it go in deep recession, or rather land softly into below trend growth? What is more, the other question in investors' minds is, will we see a great divergence in economic outcomes across different parts of the world, whereby inflation and growth move at very different speeds? Now, against this backdrop, it remains very challenging for investors to assign probabilities to this multi-speed and multi-scenario outlook. So perhaps against this uncertainty, a global and opportunistic bond investment strategy has potential to outperform. Much will depend on how policymakers act and react to economic data and market moves. So it remains very important for an investment strategy to be able to allocate dynamically to a balanced set of return drivers throughout the cycle in order to achieve a smoother portfolio return journey for investors. At the same time, disciplined risk management and position sizing remains very important in this highly volatile market environment that we see right now. Despite seemingly high correlations, if you look at the past decade, there has been a high dispersion among the best and worst performing bond markets, which has averaged around 19%. So the opportunity to outperform is there. Our global opportunistic bond strategy is very much focused on macro sources of risk and return, such as duration management, yield curve positioning, and country selection. In addition, there is a focus on generating income through spread assets such as corporate credit and emerging market debt in an improving risk-return environment. Currency selection can also be utilized as a return driver where appropriate. Coming into this year, we were positioned quite opportunistically with a relatively light footprint in both rates and credit. And that has helped insulate returns to a large extent amid the indiscriminate market sell-off we saw in the first quarter of this year. Now, since then, we have been adding duration risk very cautiously as yields have been backing up, with a focus on not missing the inflection point in this tightening rate cycle. So ultimately, we think that this will be a sharp but short cycle, that the Federal Reserve will push rates up until something breaks, and that when the inflection point comes, that will come very suddenly and aggressively. So not missing the inflection point is particularly important. Now, the other big question is whether the growth data that come out, whether that will be worse than feared, or whether central banks will temper their rate hikes as we approach the end of the year and engineer a softer landing. Now, risk assets seem to be pricing the latter scenario at the moment, expecting a softer landing, whereas if we look at rates markets, they're much more nervous at the moment and pricing a worst case scenario. In this environment, we're comfortable to add duration risk incrementally when you consider that we are past peak growth, potentially at peak hawkishness when it comes to major central banks such as the US Federal Reserve, but there is uncertainty around whether inflation has peaked. So it's much more preferable to focus long exposures to markets where a lot has been priced in already, but the growth outlook has deteriorated further, such as the US, the UK, and New Zealand. Now, over to the euro area, there is much pressure on the European Central Bank to finally raise rates despite growing recession risks on the horizon. Now, given the stagflationary risks that we see in Europe, deteriorating fiscal dynamics, heightened indebtedness, and at the same time, an outlook for the European Central Bank to end its asset purchases, we think that this is supportive of underweight positioning in sovereign spreads. In Japan, government bonds are starting to look particularly vulnerable given the depreciation of the yen, which makes more likely that there might be a currency intervention or an adjustment in monetary policy. Now, in emerging markets, the repricing there has been quite painful for many investors, but absolute yield levels are starting to look more appealing at the moment. And a lot of the inflation risk, the upside inflation risk, but also the central bank action, the rate hikes has already crystallized. So there are pockets of opportunities there, particularly among emerging markets that are very much focused on exporting commodities and energy in particular. In corporate credit, US investment grade bonds are now trading back to long-term averages when you look at their yields and credit spreads, whereas Euro investment grade bonds start to look cheap. In the high yield credit space, credit spreads have moved significantly there as well, but valuations do not look as cheap, so there's still some way to go there potentially. And when you look back to 2018, what we saw back then was that it took tapering talk around central banks ending their asset purchases for lending channels and corporate financing to start to dry up. So looking forward, it may be a good idea to wait for that quantitative tapering to begin more in earnest, for central banks to cut their asset purchases further, and for growth to slow down further before adding to credit risk significantly. So we're being patient there, waiting for a more significant valuation adjustment before we add much more to credit risk, so that the risk-return dynamics start to look more favorable. A light footprint in FX risk also looks like a good idea right now, as it still remains difficult to challenge the strength of the US dollar at this juncture, given that the Federal Reserve continues to lead this tightening cycle, as well as expectations around the US economy slowing down, but by much less than the rest of the world. Now, overall, the carry outlook in global bond markets looks very favorable looking ahead. as we begin to add to both duration and credit risk as the risk-return balance improves.
Allianz Global Investors.